When foreign investors establish a company in Vietnam, accounting is often treated as a routine operational task. Something administrative, something simple. And because of that, many FDI companies choose accounting providers quickly, often based on low price, convenience, or informal recommendations. At first, everything appears normal. Monthly reports are submitted, taxes are filed, basic communication exists. But months later, or sometimes years later, serious compliance problems begin surfacing. Missing documents, audit failures, tax exposure, payroll inconsistencies, or financial records that cannot withstand regulatory scrutiny. And in many cases, foreign investors realize too late that the warning signs were visible from the very beginning. Every business wants to manage costs efficiently, especially startups and SMEs entering a new market like Vietnam. But when accounting service pricing appears unusually low, foreign investors should ask an important question: what level of compliance oversight is actually being provided? Some low-cost accounting providers focus mainly on filing tax reports mechanically. There may be little proactive review, little risk assessment, and limited documentation control. As long as no audit or inspection occurs, the company may believe everything is functioning properly, but underneath the surface, compliance weaknesses can quietly accumulate over time. In Vietnam, low-cost accounting often becomes high-cost correction later. Not all accounting firms in Vietnam understand the realities of foreign-invested businesses. Some providers mainly support domestic household businesses or small local enterprises, but FDI companies involve very different compliance requirements. Foreign shareholders, cross-border transactions, expat payroll, intercompany arrangements, foreign contractor tax, English communication, and annual audit coordination. If an accounting provider lacks practical FDI experience, they may unintentionally create compliance structures that become problematic during audits, tax reviews, or licensing procedures. Foreign investors should never assume all accounting firms operate at the same level of sophistication. One of the biggest frustrations many foreign investors experience in Vietnam is poor communication from accounting providers. Emails go unanswered, questions receive vague explanations, compliance risks are not clearly explained, or management only learns about problems after deadlines have already passed. This creates significant operational risk for foreign-owned companies, because foreign investors often depend heavily on local compliance partners to understand Vietnam's regulatory environment. If communication lacks clarity, responsiveness, or transparency, hidden compliance exposure can develop very quickly. A strong accounting provider should not simply submit reports, they should help management understand what is happening inside the company's compliance structure. Another warning sign many foreign investors overlook is when accounting providers never challenge risky decisions. Everything is approved immediately. Every structure is described as no problem, no concerns are raised, no risks are explained. At first, this may feel convenient, but experienced foreign investors understand that strong compliance advisors do not simply say yes to everything. They explain risks, they ask questions, and they help clients avoid mistakes before authorities or auditors discover them later. In Vietnam, silence about compliance risks is often more dangerous than hearing uncomfortable advice early. Many accounting problems in Vietnam do not begin with taxes, they begin with documentation. Missing invoices, incomplete contracts, unsupported expense claims, or banking records that do not align with accounting entries. Some accounting providers focus only on entering numbers into reports, without maintaining strong supporting documentation systems behind those records. But during audits or tax inspections, documentation becomes critical, because Vietnamese authorities and auditors rely heavily on documentary evidence. If the accounting provider does not maintain strong documentation discipline, the company itself ultimately bears the risk. Many accounting providers appear responsive during onboarding, but the real test begins during audit season or tax inspections. Some providers become difficult to reach, others shift responsibility to the client, and some struggle to explain historical accounting treatment when auditors begin asking detailed questions. This creates enormous stress for foreign investors who assumed their compliance structure was already under control. An accounting provider should not disappear when scrutiny begins. They should be capable of supporting the company during the moments compliance matters most. Imagine a foreign-owned trading company operating in Vietnam for several years. The company selected a low-cost accounting provider because operations initially seemed simple. Reports were submitted monthly, management assumed compliance was functioning normally, but during annual audit season, serious problems emerged. Supporting documentation was incomplete, several tax treatments were handled incorrectly, payroll records contained inconsistencies, and communication with the accounting provider became extremely difficult once auditors requested clarification. The company then faced additional accounting fees, audit delays, and growing regulatory concerns. What initially looked like cost savings eventually became a much larger operational and legal risk. At LTS Law, we regularly advise foreign investors who encounter legal and operational problems connected to weak accounting structures. This is why we believe selecting accounting providers should be treated as a strategic business decision, not simply an administrative task. Although LTS Law does not directly provide accounting services, we help foreign investors identify accounting and audit partners that have been professionally assessed for FDI capability, English communication standards, transparency, responsiveness, ethical conduct, and practical understanding of foreign-owned business operations in Vietnam. Because sustainable compliance requires more than submitting reports, it requires building systems capable of surviving audits, inspections, and long-term operational growth. Many foreign investors only recognize accounting red flags after compliance problems have already affected the business, but by that stage, correcting structural weaknesses becomes far more expensive and difficult. At LTS Law, we help foreign investors understand that strong compliance begins with choosing the right partners from the beginning. If you are operating or planning to establish a foreign invested company in Vietnam and want guidance on selecting suitable accounting or audit providers, book a consultation with LTS Law. Because in Vietnam, the wrong accounting provider may create risks your business does not discover until it is already too late.